Hi everyone, this is Al Brooks, and this is part of my live trade series. I took a trade today in one of my actual trading accounts, not just a simulated account, to illustrate how to manage scaling into a losing trade. This is TradeStation. Here's today. This is the Globex market. The day opened right here, the day session. And this moving average is based on the Globex chart. If you look at the day session chart, which I'll show later in the presentation, the moving average is actually down here. So we opened above the moving average and we sold off, but we never went below the moving average. I'm going to speed this up so that we don't waste time on prices that really don't add anything. We have a very climactic open, a series of buy climaxes, 1, 2, 3, 4. And typically you'd expect at least a couple legs sideways to down. It's possible it's 1 pullback 2. It's more likely it's 1 pullback 2. So it's more likely that we're going to form a lower high and test this low. Less likely that we'll just keep going up. So it's reasonable to sell. Possible wedge, 3 legs up, 1, 2, and 3. We have a bear bar closing below its midpoint, so I sold at the market on the close of that bar, betting that we'll get a second leg down to this low. It's possible that this breakout is strong enough to get 3 legs up, starting to count over again. So instead of 1, this becomes 1, 2, and 3. The bears need to get a reversal here for a test down to that low or this low. So it's reasonable to sell again, sell more. So now I'm short 2 contracts. I could exit on a stop above this sell signal bar, or I could exit if we get a pair of consecutive bull bars, or I could just hold short and look to sell more higher up. It's reasonable to take this short, but if we're breaking above a wedge, we might go up for a measured move up based upon the height of this wedge. Now we have a big bull bar and a bull follow-through bar. Most traders, as soon as they see that, they should buy back their shorts on the close of the bar. However, it's reasonable to hold short and to sell more. And I'm going to do that in this particular case to illustrate a couple of things. Now, if you wanted to, you could have exited short and gone long. And normally, if you have a trade that is doing a low probability thing, something you think is unlikely, you're going to get some kind of a measured move, maybe a measured move up based upon the height of this wedge. So if you were able to get out of your short and get long here, you're probably going to rally for about a measured move based upon the height of this wedge or based upon the height of this. Instead, I'm short 2 contracts, and we have a very good bear bar. If it goes below that bear bar, it probably will come down low enough so that I can get back to break even. Now, I really need to sell double my position, so I just sold a 4th contract right now. I sold 1, I sold 2, I sat through the breakout, and now I'm trying to get out break even, which I just did. It hit the average entry price between this short, and then there's these shorts here, and I was able to get out break even. Now, normally you should not be shorting in a strong bull trend like this, but this had a special situation, and I'll talk about it in a moment. In a strong bull trend like this, most traders should only be buying, and they will lose money if they short. You can simply buy above any bull bar closing at or near its high. Remember, this is the day session, and I said that the moving average was below the low of the day. So we opened here above the 20 bar exponential moving average, and we did not touch it. Now there's a special thing going on here. I've been trading now for, 35 years. I've never seen a day that opened above the moving average and went all day without touching the moving average. So 35 years, that's a long time. And the statistic I use is 99.99% chance we're going to touch the moving average. And in fact, 99.95% chance we'll have at least 3 bars with lows below the moving average. So knowing that, it's reasonable to sell below that bear bar, especially if you sold earlier and you're scaling in. As I said, 80% chance if you sold here or here, and then you sold more here, you'll get a pullback at least to your average price. This sell-off went almost down to your original entry price. And had you held short, you would have come close to getting out break even on the original 2 sells and with a profit on the higher sell. One other thing, I said 99.99% chance we're going to get to the moving average. When it does, usually if you get a bull bar, you're going to get a test of the high. So this was a bear trap. The bears hoped that the breakout, the close below that low, the close below the moving average, was going to lead to a bear trend. But as soon as you get a bull bar, you know the odds are 80% you're going to go back and test the high. So I would look to buy again above a bull bar closing near its high here or here. Experienced traders will buy all day, but a few will take shorts based upon the knowledge that the market is going to pull back to the moving average. And if they scale in, they can make money, or at least avoid a loss on their shorts. Again, special situation. The market goes 50 or more bars without touching the moving average. You know it's going to touch the moving average. Well, you know anyway it's going to touch the moving average. It does every day. I don't remember a single day in 35 years when the market did not pull back to the moving average. So the odds are very high that we'll get there. We can get there by going sideways or by going down. An experienced trader, if they see a bear bar closing near its low like that or that, they'll short, looking for at least a scalp. The bears are not expecting a bear trend. They're looking for a scalp, just a small profit down to the moving average. And if they're smart, they'll look for a bull bar closing near its high for a test of the high of the day. It's reasonable to take this short. As I said, after a climactic rally like this, the market usually enters the trading range. And it did, but the trading range was up here, so it did not enter the trading range here. However, it probably was going to. As I said, we probably were going to get a couple legs down, 1 bounce 2. It's possible that this was 1 bounce 2. So it's reasonable to short here. Most traders, if you get a bull breakout bar, a close above the prior minor lower high here, and then a bull follow-through bar, you know we're going higher. So most bears should exit above this second bull bar and take their loss. But experienced traders can hold, knowing that if we get a bear bar closing near its low, at a minimum, we should come back to the midpoint between the entry price below that bear bar and this bear bar. That took place over here, but since I scaled in, I sold here, I sold more here, my average entry price was a little bit higher and not down here. Most traders, if they're short in a strong bull trend and you get a big bull bar closing above the high of the prior bar and closing above a minor lower high, here closing above the high of the past 15 bars, they should be thinking about getting out. And if the follow-through bar, the next bar is a bull bar, they definitely should get out. And the reason for that is if they're looking to scale in, they'll mess up. They won't do what they need to do. In fact, if they're able to reverse to long, they'll probably be able to make up for their loss. So if they sold here, sold more here, and bought 2 here, it'll probably go up high enough to erase the loss that they got on those shorts. But the reality is most traders are not going to be able to reverse. Most traders do not reverse. I don't like to reverse. Alternatively, if you don't get out, the second choice is to hold short. Wait for a bear bar closing near its low and sell again. But not just sell one contract. You should be doubling your position. So if you short 1 here and 1 here, short 2, and you should therefore sell 2 up here. You should double your position. It sounds easy, it looks easy, but it's not easy. The market came down a little bit below the average entry price. So if you had a limit order to get out break even at your average entry price, you could have gotten out there. Never scale in against a strong trend unless you're trading small enough so that you can do the right thing if the market goes against you. Most beginners trade too big and they get scared, and they exit at the exact time when they should be doubling their position. And that's the problem. The beginner thinks, oh, I'll sell 1 contract, that's not too big. I'll sell 2 contracts. That's still not too big. I'm a little bit uncomfortable, but can they sell 2 more here? If they're already uncomfortable here, they're not going to double their position here. And if you're selling and you did not get out above this second bull bar here, the correct thing to do is to double the size of your short here. Again, never sell in a strong bull trend unless you have a good reason to expect a profitable scalp, and if you're experienced enough so that you don't panic when the market continues to go against you. In this particular case, we've been above the moving average all day. We know there's a 99.99% chance that the market will pull back to the moving average, and there's a 99.95% chance we will have at least 3 bars with lows below the moving average. This low is a little bit below, this low is below, that's below. So now we've met the minimum objective. And then once you get a bull bar after those 3 bars, 80% chance you're going to go to a high. You could have bought above here, you could have bought more here. You know 80% chance we're going to test the high of the day. Most traders, when they're wrong, it's often better just to exit break even than hold for a profit. So selling here, better just to get out break even. This is a surprisingly strong breakout, and we may go higher, and therefore it's better just to try to get out break even. Sold, and then sold 2 more here. Here's your average price. Get out there, break even. You have a loss on here. You have wins on these 2 contracts. The net is a break-even trade. Never be greedy when you're wrong. Never hope that the market will go far your way when you're betting against a trend. So if the market does something surprisingly strongly against your position, it's better just to try to avoid a loss and not worry about making a profit. Again, most beginners cannot do this. And most experienced traders do not do this, but a trader who understands what's going on and they know the odds of the market pulling back to the moving average can do this. You have to trade small enough, and you cannot get scared when the market goes against you. And that means most traders should not do that. This is an example of how if you do sell in a bull trend and you understand that there's a good reason for the market to go down, you can scale in against the bull trend and avoid a loss. If it went down initially here, you would have made a profit. If it went down here for a wedge, you would have made a profit. Instead, it did that. Once it's done that, it did something other than what you thought was likely, it's better just to get out, break even. I'm Al Brooks. Thank you for watching this video, and I hope that you found it helpful. This is a video on scaling in to avoid a loss. Here we got a pullback and then a bear bar closing near its low. Every time you see a bear bar closing on or near its low, it's a reasonable short, 1 tick below the bar. And you don't have to take every one of these shorts. All right. A lot of times it happens quickly and you don't expect it. When you see this breakout, you're thinking, well, Al says 75% chance it's going to reverse up. Maybe I shouldn't sell. It's reasonable to take the sell, and then if you get the reversal, get out, because sometimes you'll get a big trend down. And after 3 or 4 bear bars, if you're still flat, you're thinking, oh my gosh, I'm missing something. What do I do? How do I get in? What you do is you simply place an order to go short 1 tick below any bear bar. You could wait for a pullback and then start. But when you're in a strong bear trend like that, you have to get short. And the easiest way to do it is wait for a bear bar closing near its low and then enter on a stop 1 tick below the bear bar. Bear channel, 3 legs down, 1, 2, 3, and a pretty good looking bull bar. Late in a bear trend, you're probably going to get some profit taking late in the day. So I would get out of shorts above that bull bar. And in fact, I personally would buy looking for at least a couple legs up, some profit taking at least to the moving average. Now, 4 types of channels. And there are some subtle differences here between this channel and this channel. I don't know if you can see the difference, but In this channel, we have bull bars, but no bar goes above the high of the prior bar. So I call that a micro channel. And it looks similar to this, but it's not. It's different. This is a micro channel. There are no pullbacks. And on the next higher time frame chart, let's say this is a 5-minute chart. If you look at a 15-minute chart or a 30-minute chart, you don't have any bull bars. It's just a series of bear bars. So a micro channel is the strongest type of bear trend. And you only want to sell. And the next strongest type of bear trend is this. It's a small pullback bear trend. The pullbacks are small, 1 or 2 bars, and you keep making new lows, and the pullbacks do not go up very far. So they're small and they're brief. And whenever you see the market looking like this, don't buy. You only want to sell. So a micro channel, you only sell. A small pullback bear trend, you only want to sell. And on a higher time frame, this is going to be a breakout as well. It'll just be a series of bear bars. If this is a 5-minute chart and you were to look at a 15-minute chart or a 30-minute chart or a 60-minute chart,